banks will become like utility companies. They will be boring or custodians, like boring places where they keep the reserves, they do all the checks, they will charge 20 basis points for their job. Nobody will go there, nobody will like to work there, and the rest of the fun will actually happen somewhere else. It will be like server storage.
Today, I'm sitting down with Luca Prosperi, the co-founder and CEO of M0. Luca and his team are building what they refer to as the universal platform for stablecoins.
Stablecoins are pure deposit and payment instruments, and way better than bank deposits. Also from a tech perspective.
We dive deep into what money is, what's wrong with our current banking system. I hope you enjoy, and to remember to go direct. So welcome, Luca. How are you doing?
I'm good. Fighting the heat, like everyone in Europe.
For sure. We're both in Europe right now. As you can see by my screen, there's the sun's beating down on me in the studio. And Luca said he's nice and warm up in central Italy. So great. So just quick little primer here before we hop into it. So as you all know, Going Direct's all about decentralizing the real economy, and the only way we're going to be able to build these new decentralized systems is we have to outcompete incumbent ones, and so we inherently need a decentralized financial system to make this a reality. Money and finance is what makes the world go round, as Luca will explain. And so that's why we're here today, to dig like pretty deep into stablecoins with Luca. But I think what's even more interesting is your statement that you make, that you believe that everything in the future is a bank. And so I think that's like highly relevant for the community. And, most of you all are building kind of these completely vertically integrated solutions. So becoming your own bank among your customers and suppliers and creating your own ecosystem around payments, lending, et cetera, outside of the traditional system gets me pretty excited. So anyways, I'll shut up now and let Luca do the talking. But Luca, so most folks are not crypto natives. And so if we could do a little 101 on this, which is, in your writing, you repeat yourself over and over again that money is debt. And moreover, money is the most complex mass adopted product there is. So can you just explain to us, from your understanding, what money is in its most basic form?
Yes, and it's a difficult task, but I'll try. I'm also not crypto native, right? I'm a mathematician and economist, and I used to be a banker by background. I used to invest and advise financial institutions, but I have been deeply involved in the financial intermediation space, which is a lot more than payments, right? It's how actually money is created, value is represented, and how it moves around. I think, interesting enough, I think that when it comes to financial services, we already have a decentralized system. We have a decentralized system that used to be very advanced in the 70s, and now obviously we can do so much better with technology, right? But the way the system works is that ultimately, you mentioned that I refer to money as debt, right? Think about it, like I think most people just give the balance on their bank accounts as a given. Like, there are X dollars in a bank account, or like $1,000 in my bank account. I have $1,000. There are $1,000 somewhere that belong to me. Like, the people that are a bit more sophisticated, they think that this is actually not necessarily your dollars. That maybe it's someone else's dollars. But I think the bank is just keeping the checks and balances. And then if you go there and ask for the money, you'll get the money. It's not even like that. That money that you see in a bank account doesn't exist. So what it means is that the bank actually is fairly confident that if you go there and ask for the money, you cash the money, you will have the money, or fairly confident that there is more value in its balance sheet than what is the debt that the bank owes to its depositors. And I'll make an even clearer example. You go to a bank, you ask for a mortgage. You're buying a house of, I don't know, like $100,000, and you want a mortgage of $80,000. And the bank says, okay, I'll give you the mortgage. Here's the money. You can buy your house. Now, people think that this money is someone else's money that the bank is giving you as a loan, and then they will just match the maturities. This money that appears in your bank account is magic money. It doesn't exist. What a bank is saying is that, okay, I have a collateral that I think is worth $100,000. I feel fairly confident to credit this person $80,000. But that stuff doesn't really exist. So money ultimately is a debt form where either the bank to us or us to the bank with our salaries, etc., we exchange debts and credits. The hope is that debts and credits will kind of match over the long term. And we know this is not always the case. Like if we know that the famous bank run scenario, that everybody goes to ask money to the bank doesn't have the money. So it is already a complex system of balances. Now, what happens in this is the first layer that we see. There is a layer behind, and the bank does it. Why? Because the bank is doing the same with the central bank, and the bank is pledging assets to the central bank. The central bank is giving credits and loans to the bank. The bank is buying treasuries from the state. So there is a very complex relationships of debts and credits, and it kind of works. And it works and it's fungible in a way that we actually use the money as a fair representation of value, and we use it to move it around. Has worked quite well since like the 70s, right? Since the money stopped being pegged to some sort of hard asset. Now, it's the funny situation that happened in the last 5-10 years with crypto, and that's what fascinated me in crypto, is while the first generation of fintech, so-called technology, attacked finance by creating a fancy overlay to the traditional banking system. So you didn't have to go to the branch. You could go on your Venmo, you can go on your Revolut app or whatever, Robinhood app. But then these guys were connected behind the scenes with the traditional banking system. But it was already a very powerful innovation. What happened with crypto is that for the first time we had an infrastructure that was solid enough, a technology that was solid enough that we could say we can actually get rid of all these intermediaries that keep the checks and balances and have thousands of people employed. We can actually redo all those controls and checks and balances that connect assets and liabilities with code. And some crazy people started to do it within the crypto native system, and now we're expanding it to the whole system. So when I'll stop in a second, but when we obviously somehow ironically say, like in our insiders campaigns, everything is a bank, is that like every business is embedding financial services in it. Currently, these businesses are served by legacy, antiquated institutions that, in order to feed the beast, the hundreds of thousands of employees and shareholders they have, they are sucking most of the upside from those businesses. Now, with code, in the same way, you can actually run your own shop on internet without actually opening a shop in a mall or begging the New York Times to actually leave you space. You could actually do the same. You could actually bootstrap your own versions of money within your premises that is as safe as anything else, is as liquid, and you don't need to bend the knee to like very, very powerful gatekeepers. And that is happening as we speak.
Great. Thank you for that breakdown. Let's move over to the stable coins. People have described, I mean, just very broadly, right? Stable coins is kind of the lubricant that keeps the cryptocurrency moving today. Can you just break down a little bit for the audience, like what a stable coin is in its most basic form? I know there's multiple use cases, but in its most basic form.
Yes, stablecoins are also evolving, right? But at the beginning, it was relatively easy. Like you wanted to play within the crypto sector. So you wanted to buy crypto assets, you wanted to send assets to someone through a wallet. Crypto makes the system fully interconnected in a very cheap way. Some institutions decided to create these pegged assets that were not super volatile like Bitcoin or ETH, but pegged asset to $1. So it's like, you give me $1 in fiat, I will deposit this dollar in a bank account and store it for you. I will give you a digital version of this dollar, and you can use it in crypto to do whatever you want. And at the beginning, it was used for trading mainly of crypto assets. And then soon enough, people started to discover that it was so much easier to move money around internationally or to store money on crypto wallets instead of just sending this through traditional rails. Try to send an international wire through Swift. It takes 3 days. You don't even know how much they're charging you. Sometimes they lose the money. So that the amounts grew up to the point where currently there are $250 billion of stable coins floating. Stable coins are used for more and more use cases. More traditional financial institutions are using this tool. And also the way you manufacture stablecoin is changing. So at the beginning, it was like fintech. You give me $1, I put it in a bank, it's the same. I'll give you a digital representation of it. It's like having a bank opening a branch on chain in crypto. Now people are using the technology not only to move the money around, but also to print the money. So you can print the money connecting assets and code, and you don't need banks. And this is the big revolution. Like in the US, this is the crux of the legislation that is passing now, the ability to actually print stable coins without the intermediation of traditional banks.
Yeah, you're referring to the Genius Act, right? So we'll get into that. So over the past 2 to 3 years, you just mentioned about $250 billion worth of stable coins in use. Circle just went public. Many of the fintech companies are now introducing their own stablecoin products, but the use has really exploded over the past 2 to 3 years. What do you like? What do you attribute that to mostly?
I think a couple of things. I think that first of all, it was a natural evolution of of the adoption curve. Builders started to get more familiar with the technology and understood some of the use cases. Some people started to use it for the lowest hanging fruits, for example, international payments, and others followed because it is the technological superiority is just obvious. And obviously some big players moved. So as most people in my sector, but probably not everybody knows, Stripe, the giant payment company, bought Bridge, which was a stablecoin startup for $1.1 billion. They started to embed stablecoins within the rails that they're using, and others followed. Obviously, Circle is now IPOing. I mean, now IPO'd very successfully. So it's becoming more part of the mainstream. Obviously, in the last year, the change, and I'm absolutely apolitical, but the change in the administration in the US was a massive boost. I'm not American. I spend a lot of time in the US. Most of my investors are in the US, and most of my businesses business builders are in the US. And I've seen on my skin how antagonistic the previous administration was. It was pretty much impossible. And with this change in the policies so far, obviously it's so much easier also for big businesses to feel like to be associated with crypto rails or anything that goes around the blockchain. Obviously, this was like a very, very big, very big boost. The regulatory overhang was one of the most powerful limiters.
Sure.
Until like last year.
And so, yeah, moving over to the Genius Act. So it was passed in mid-June by the Senate. I think it's now going over to the House, if I'm not mistaken. You briefly mentioned it, but I think it's really important to dig into. Can you just dig into a little bit of what the Genius Act represents for the world of stablecoins and why it's such a big deal?
Yeah. So until now, there is no legislation that actually covers stablecoins in the US. So most players operate in some sort of a vacuum at the federal level. They have money transmission licenses at the state level or New York licenses, but it's a bit complicated. Now, the U.S. administration apparently realized how strategic it is for the U.S. to support this innovation, because ultimately they also have the ability to increase the reach and the distribution of the dollar, which has a lot of positive impacts on the U.S. The USA. There are many ways. The same that happened with oil in the 70s, right? Like when everybody was actually trading oil with dollars, and this probably pushed down the interest rates for the U.S. for like 50 years. So they've been quite supportive, but the level of support and and the support for the innovation was surprising, also for insiders like myself. Why? Differently from what happens in Europe, and I'm European, and sometimes it's frustrating to see how Europe puts regulation and protectionism first. Under Genius Act, you can actually, issuers of stablecoins up to a certain size, they can issue stablecoins without actually having the deposits deposited as bank deposits. So they don't need to have like a bank creditor behind, which is very risky for people who don't know. Like the event that almost brought down Circle and stablecoins as a whole was the failure, the default of a traditional bank, Silicon Valley Bank, that was actually holding a big majority of their deposits in unsecured loans. Like we all know, like if our bank goes down beyond a certain amount of money we are insured for, we don't get our money back, unfortunately. Now, the Genius Act gave the possibility for issuers to issue without passing through banks. So by actually reserving with U.S. Treasuries, super safe money market instruments, the stable coins. So like making stable coins very safe, but without the intermediation of the commercial banking sector. They have had they've opened the possibility of for those assets to be in tokenized form, so in different forms, in bankruptcy remote tokenized form. That again was very pro innovation. They have done another thing which is massive, which is related to what I was saying before in terms of default risk of a bank. They have given super seniority in case of bankruptcy to stablecoin holders. So by law, if the Genius passes as it is, if you own $10 million of stablecoins and your issuer goes down, you actually are super senior in case of bankruptcy before any other creditors, and your claim is fully reserved. This is not what happens in the US, in banking, right? In banking, your claim is partially reserved, and you, beyond what is protected by the state, you need to go with the rest of the creditors, which is a tragedy. So that's why we always imply that the U.S. are going to the governments are going to bail out failed banks, but this is not written anywhere. Plus, they had a few other things related to yield distribution, related to AML, etc. But overall, it is a very promising step forward towards a new generation of money issuers that are not necessarily intermediated by the gigantic banking sector, which is very antiquated, right? Like we don't need these monopoly, do-it-all institutions in the 21st century.
Yeah, it's funny. I just think I was just speaking to a banker of mine last week, and I was talking at one of the big traditional banks. I won't get into that. And you're just like, man, you guys literally don't do anything. They literally don't do they bring no value to anything that I'm doing in a very interesting way. Like you have this very big centralized system, this banker who has to go get all these approvals and puts everything into a computer and doesn't even make any decisions him or herself. It's like very fascinating.
It's not only that. I think that in the last 20 years, most of the credit, like the underwriting, the credit risk, was not even taken by banks. It's been taken by funds. Funds have been investing in corporates, have been investing in mortgages, etc. So the bank was just an intermediary, and the bank had monopoly on the deposits. Like is the only place where people could feel safe to put their deposits, but also their technology stack is terrible. So if you want to connect technology to it, try to do agentic commerce with a bank deposit. Forget it, right? Or so sure. Obviously, if you're giving the word like a safer, tech-heavy, distributed system that represents money, why on earth people would put money in a bank? And this is the unfortunate truth that we need to deal with, because obviously banks are crucial for our ecosystem, and it's not that we can switch them off overnight, but this is a trend that is inevitable. So I think that the role they had, banks I'm a banker myself. I used to be a financial institutions banker. I used to be a banker for bankers. Has changed. 50 years ago, 70 years ago, you needed the branch to collect the money. You needed the banks to have the relationship with the territory. the branch to lend money. Now, I don't know, like, how many people under 30 have ever entered a bank branch more than once every 5 years? I mean, I don't even remember last time I went into a bank branch personally. And for sure, I was very annoyed when I went there because I had to sign some paper and some bullshit KYC that I could have done on a computer.
It's funny. I have a couple guys that work for me. I think they're like 27, 28, and literally they've never had a bank. They've never had a real like a bank account at Chase or Wells Fargo or anything like that. So to your point, interesting. You made a comment under the Genius Act. Stable coins are already safer than bank deposits. It's a pretty big statement. So explain that a little bit.
Yeah, it's what I mentioned before. A bank deposit is guaranteed up to a certain point, and then for the rest is exposed to the same risk that a bank has, because a bank deposit is ultimately a loan you're giving to a bank, and the bank is doing many things. A bank can default. A stable coin, the way it is defined today, for stablecoin, pure stablecoin issuers, needs to be fully collateralized by treasuries, so risk-free assets. And in case the issuer goes down, those assets can be bankruptcy remote and can be used to actually make whole everyone. So it's safer than a bank deposit. Now, stablecoins, what it means also that stablecoins do not do credit creation. The credit creation is still reserved to the banks. I think this will change as well. But as things stand today, stablecoins are pure deposit and payment instruments, and better than stablecoins are way better than bank deposits, also from a tech perspective. The only thing that the legislation has tried to protect bank deposits is forbidding issuers to pass down the yield to the ultimate users, which is also not in the interest of the user. They're saying this stuff is so good compared to your traditional bank account that if you want to get 1 or 2% of yield, you need to get it from a bank. You cannot get it from a stablecoin. Now, the stablecoins could pay you 4.5% of yield because their cost structure is very lean, but the government doesn't want you to do it to protect the banking sector. We know, and we have seen this in history over and over again, this level of protectionism doesn't really work. The utility and usability is paramount importance for money. So people will probably forego 50 basis points or 1% of yield they get on the current accounts, and then at some point the dam will break, and deposit and stable coins can also pay to the issuers a yield. Currently, stable coins, they pay yield. They pay to the distributors. So Circle is paying a bunch of cash to Coinbase. Coinbase is actually giving the cash to the users, but because of regulation, they need to mask it as some sort of marketing reward, which is like legalese for yield. But I think this is just an interim phase.
Yeah. So just for all of you out there, just to reframe, just to make sure it's clear. So when Luca is saying, like, in the US, the FDIC insures your bank deposits up to $250,000 per account. Anything above that, if anything goes wrong with the bank, you're getting in line. You're getting in line with other creditors, and you're not going to have a super senior position. And all he was saying is, under the Genius Act, is part of the act is the issuers of the stablecoin are required to report and have a 1-to-1 ratio of an asset to back up that stablecoin, right? So it's actually a much safer situation if something goes wrong, that you're going to actually get your money back above that 250,000. Is that accurate the way I summed that up?
Yes, it is. Banks typically have a 5-to-1 ratio about the money they have and the money they give away. Now, obviously, on the other side, this means that stablecoin issuers can do way less things that banks can do. So their business model is way more limited. But that's a different topic.
Okay, let's move over to this centralization versus decentralization conversation. So obviously, this legislation is going to bring many incumbent institutions and traditional and centralized financial institutions into the world of stablecoins. Obviously, I believe you and I both get very excited about the decentralization component and something being natively decentralized, and to remove the middlemen and gatekeepers. You had a quote from an interview that you gave not too long ago where you said you don't believe in a future with Bank of America issuing their own stable coins. Why don't you believe in that future?
Yeah, I mean, I think this future will happen. I think just simply nobody will care. What I'm saying is we now what you mentioned is I think is correct. Like after legislation will pass, every bank, every financial institution in the US will try to launch their own branded version of the dollar. Now, fine. The question is who will actually use it? And I think that the only reason you use a dollar, a digital dollar, if you like the services that are embedding these digital dollars, right? So if if Robinhood, I'm just making using random names, right? But if Robinhood is actually partnering with JP Morgan, where JP Morgan dollars are powering the Robinhood platform, people will use the JP Morgan dollar. People will not, if JP Morgan will use their dollar within their own ecosystem, people will use the dollar within their own ecosystem. But I think we need to flip this upside down. I think the key question is who are the coolest builders of new financial technology services and what dollars are these guys using? And whether they use a JP Morgan branded dollar or a Fidelity branded dollar, most of the money will go to them. Most of the money will go to the application layer. So you see all these bankers trying to launch their stable coins because they see two companies that started this sector, Tether especially and Circle, making incredible profits. Tether is a company of 100 people. They make more profits than Goldman Sachs, which is insane. I think they have the highest profit per person ratio by a factor of 5x of anyone. Is they make $16 billion of profits a year. Now they do this because they also invest in less safe assets and they are fully offshore. But even if you take, they currently have $150 billion or $160 billion. Even if you take $150 billion, you multiply this for 4.5%, which is the Fed rate. You do the math, right? This is probably $7.5 billion of pure profits. So everybody wants a cut of that. But the question is, will they be successful? And my thesis and our thesis at M0 as a company is actually no. I think that the guys who will dictate the economics will be the builders of financial products. They will use stable coins to lubricate the pipes of their business. And we need to create a technology that is actually connecting all these financial issuers that will become, banks will become like utility companies. They will be boring or custodians, like boring places where they keep the reserves, they do all the checks, they will charge 20 basis points for their job. Nobody will go there, nobody will like to work there, and the rest of the fun will actually happen somewhere else. It will be like server storages. And so our opinion, our thesis is to create a technology layer that actually can connect all those asset storages with actually the builders of the new fintechs of the future, because these guys, they want to control the stablecoin, they want to brand them, they want to own the yield, they want to redirect the yield, they want to decide who has having compliance rights, etc. These are all things that traditionally were done by banks, because the banks were also the place where the fun was happening. But now, as you mentioned, the fun is happening somewhere else. The fun is happening at the fintech level, and the bank behind the scenes is just a backend. And they should be like a backend, and they should be paid like a backend. Currently, this is not the case. So the reason why I believe that the future is in this technology in the middle is that the most important thing in money is liquidity and interoperability. Nobody knows that the dollar, nobody who is using the dollar. That's why I joke, the money is the most complex mass adopted product there is. Nobody knows how actually the dollar is produced, what are the checks and balances, what is the fiscal policy of the US. They use it because it is accepted everywhere and has a network of acceptance that is global. Now, obviously you can guess that this is not possible if you suddenly have like 1,000 different issuers that are fractionalizing this liquidity, and then who is accepting the JP Morgan dollar, who is accepting the HSBC dollar, who is accepting the Wells Fargo dollar. That's why I think there needs to be some sort of technology in the middle that is mashing all those assets and letting everyone connect.
Cool. All right, I think it's a good transition. We're gonna dig deep into M0 on that. So, I have an image I have to show because I think it really represents what you're building. So let me just pull this up here. There we go. So you can see that.
Yeah.
So
like
so
that.
for those of you that are that are just listening, there's the big bull that's on Wall Street outside the New York Stock Exchange or something similar to that, staring at the eyes of a bunch of small piggy banks. And I'll say one line, and then Luke, I'll let you take it from here to explain folks what M0 is. Very simply, you state M0 is the universal stablecoin platform. We want to help builders create their own stablecoins.
Yeah.
What are you working on?
I love this picture. This is a snapshot of a short, like 30-second video that we did for a kind of builder campaign, and with the tagline "Everything is a bank," because as I mentioned before, we think that every business embeds a financial business, and we want M0 to be the tool that wakes everything up, so that they can actually together join forces and claim back control over the money layer that was traditionally managed by, not by Wall Street necessarily, but the banking sector. And so our marketing agency worked on this video, and we loved it, like at the very beginning, and that image is great. And I think that's exactly what we want to do. I mean, M0 is a very technical project, so I will not go too much into the detail, but I think we have four pillars that are driving what we're doing. First of all, as I mentioned before, the upstream and downstream of money are completely different sectors today. So who is manufacturing the money? Like the financial institutions that have the ability to run this asset servers, so to say, are very different from the builders out there that are building cool stuff and cool products for users, right? Like, Fidelity and JP Morgans are not Revolut, Robinhood, or Uniswap, or anything else. So we wanted to create a layer that was abstracting this, was allowing the issuers to connect and the builders to do their stuff. Now we wanted to over-index on the builders. So the builders do not want to deal with hyper complicated compliance and like traditional corporate sales people from a bank that offer. The builders typically want to code. And so we created a system that allows builders to bootstrap their own versions of digital money only with code, in the same way they would work on a website. Simply, they're working on the blockchain. But whatever they want to do in just deciding the behavior of the money within their ecosystem, where the money can go, where they cannot go, how they share the yield based on whatever behavior, how they can incentivize their users, how the brand, how this money can be interoperable or not outside of their ecosystem. Everything can be done with code only, and in a matter of hours, not a matter of like months of negotiations. So you want to have like a yield rebate of the treasury rate for you to certain users. You don't need to negotiate an agreement with lawyers for 3 months and then get a rebate every quarter. You can decide continuous streaming with code. So this was the other very, very important thing for us. And then we really wanted to create something that is super thin and super light, so that the upside would stay almost entirely, pretty much, with the builders. Actually, currently entirely. Like the protocol that is kind of some sort of intermediary doesn't charge anything for users who use it. And the protocol is also, for people who are not familiar with crypto, is an immutable piece of technology that exists on the blockchain. Nobody can change it. and most probably the main users will also be the main shareholders, stakeholders of this ecosystem. So that if the protocol will accrue some fees as a spread in between what the yield that is generated by the assets and what is passed through to the builders, those fees will not go anywhere. Will just sit on smart contracts on the blockchain and can be captured by token holders, and most probably some of the token holders will also be the builders themselves. And then we wanted, while we were doing this, we wanted to work for the benefit of the community on all the building blocks that make money great. As I mentioned, the great thing about money is secure, money is liquid, and has a huge acceptance network. So we wanted to create this at the network level. So every builder who actually is using M0 code to bootstrap their own digital version of money, they can leverage the same liquidity network, the same interoperability network that of everybody else, instead of just killing each other, like Circle fighting against Tether, fighting against JP Morgan, fighting against someone else. So ultimately, we really want to recreate. I want to recreate like a decentralized like money layer, global, fully on the blockchain, and we don't need banks to run this.
Yeah, I mean, my gut tells me as someone who's not very deep into this world at all, but it just seems like that world is just going to get commoditized away when you're talking about on just the pure stablecoin side, right? It's just everyone sees the money that Circle is making or Tether is making, but it's just going to go away. I would assume, but as the technology
Yeah,
gets better, I don't know.
yeah. It's already. I mean, Tether is a different beast because Tether actually controls the distribution. If you go in emerging markets, there are
Okay.
people in emerging markets that are using the Tether dollar. It's a very, very strong brand, but it's also going to be very, very difficult to defend and to grow. But if you
Mm-hmm.
look at Circle's S1 at the IPO, there is already a big, big fat chunk of the revenues they make that is going to the distribution partners. Is going to Coinbase
Right.
and others. Now the difference with what we're doing is we don't want you. No, Circle. If you are big but not big enough to sit and negotiate with Circle, Circle is not giving you any money. So on the small guys, they are keeping most of the money. What we want to do is like instead we want to have a system that is entirely code based. So you don't need to be big and powerful to negotiate a fee rebate. It's just embedded in the code. And I think this
Mm-hmm.
is so we want to anticipate this trend. Most people are saying we make 100% profits, and we will try to defend very aggressively our profit margin until it goes down to whatever, like 1%, probably, or 5% of the yield from 100. We are starting from the opposite. We will start from 0% profits. We're creating technology, and we want to scale this technology. And then when the technology will be very valuable, and the technology will keep providing value to the builders, then we may actually decide openly, in a communal way, transparent way, to actually let the protocol clip a fee that is probably 10 20 basis points as the others should do. But we're starting from the other way around. For now, the way
Sure. I
M0
get it.
raised significant funds, we are not gonna turn a profit for a few years.
Yeah, yeah. I understand. I get the game that you're playing. Can you give us just one or two examples, because you use the term builders, and I assume most of the folks you're working with now, like you said, are actually building fintech products themselves or in the financial field. Just give one or two examples of who you're working with now, just so people can, it can be less abstract.
Yes, absolutely. Few examples. I'm thinking about the less crypto native, crypto nerdy things. But for example, there is a company called Cast. Cast, K-A-S-T. Cast is creating a new bank. So current accounts, deposit accounts, and credit cards that function as usual, like in the same way you would see like a Revolut or a Venmo from an app perspective, but the bank built entirely on stablecoin rails, and they are building this infrastructure with M0. You have people in the Hyperliquid ecosystem. Hyperliquid is a decentralized exchange, so it's a large exchange where currently digital assets are traded, but soon enough there will be other assets traded. And there are teams in the ecosystem that are building the dollars for the Hyperliquid ecosystem on M0. There are wallet infrastructures, so companies that have digital wallets where you can buy and sell and store crypto that will launch their own dollars on M0 rails. There are gaming companies. Playtron is building an open source gaming operating system with a device, and they want to have their own digital wallet in it, where also the money can power purchases across the whole ecosystem. They are building those digital dollars for the Playtron ecosystem on M0, and there are a few more. And then obviously more crypto native examples like specific chains that have very specific use cases, or DeFi projects, DeFi lending markets, businesses that are more crypto native. But in our opinion, anyone who is building a fintech company, being a payment company, a new bank, or an exchange, or an e-commerce business, or a credit card business, or an award currency like points award system, should actually control the money it's on their stack, and they should build it with M0. Currently, if you're using USDC and you are running your own exchange in Malaysia, you're not only leaving 100% of the economics to Circle, but if Circle wakes up one day, or the US wake up one day and decide to switch you off, they switch you off. You have no power over it.
I get it. Can you? There's a statement here I wanted to ask you about when you were talking about the future of lending, and you say in the future applications will use lending markets, not retail, and these applications will do loans for their own clients. Can you just talk to me a little bit about that? I thought that was a very interesting statement.
Yeah. So what I think is, in the early days of crypto was for the nerds, right? If you were a nerd, you were playing with these lending markets, with these decentralized exchanges. You were storing your money in wallets and sending it with like these ledger devices, etc. I don't think this is the future. I think this technology is going to be completely abstracted away. So people will interact with this technology in the same way they interact with traditional web applications or mobile applications. So they will have fancy applications that make things very easy. The different, like those applications will interact with the blockchain technology behind the scenes. So if you actually want to get a loan, instead of probably the application interacting through APIs with some sort of funds that is giving you loans, or they will probably connect directly to a lending market on chain. You will not see it. It's going to be like a wholesale word, but it's fully open, and it's like can be replicated by many. This is already happening. If you go, for example, if you have a lot of Bitcoins, for example, and you say, okay, I don't want to sell my Bitcoins, but I want to have a loan on the Bitcoins that I have because I want some liquidity. So let's say that I have one Bitcoin that is worth $110,000 or whatever it is. I want to have a loan of $20,000 because I need this loan. And then at some point, maybe the Bitcoin is going to go up. I don't need to repay it, or it's easy to repay it, or I will just repay it, right? Today, if you go on the Coinbase wallet, so which is like not the traditional web application, but it's like the application, the mobile app that Coinbase has, you can get a loan on your Bitcoin, but the loan on your Bitcoin is powered by a lending market called Morpho. So there is a decentralized lending market where people pledge their Bitcoins, others make a market for those Bitcoins, they provide a loan, and you can actually get a loan on your Bitcoins. You do not interact with DeFi. You do not try to understand what is the risk profile of the loan pools, etc. You just ask for a loan on your mobile app, and you get an immediate quote, and then you can execute the loan, or you can repay the loan, or the loan can actually be margin called in a matter of like seconds.
Yep. Got it.
It's a great test. Obviously, it's just the tip of the iceberg.
Yeah, sure. So let me ask you this. I'm gonna move you into like the non-digital economy, like the real economy, because this is one of the things I wanted to ask you about. So let's say I'm just giving you an example, okay? Let's just say I have a food distribution business. I sell products to bars, restaurants, hotels, and I'm really interested in this whole idea of being able to spin up my own stable coin for payments and lending activity between my suppliers, customers, like basically everyone in my network. Cause, I might be running a few $100 million through a year with this distribution business, and I'm paying all these fees to banks and everywhere else. Um, so when when would a use case like this in the real economy, when would you be able to kind of roll something out like this in a pretty frictionless way if I'm that owner of that distribution business?
I think pretty soon. I think some of the
Okay.
large distribution players, they're already looking at this. We have seen like last week that folks like Amazon or Walmart, they are thinking about developing their own stablecoin solutions. I think this stuff is going to get productized very quickly. Shopify, I think, has signed an agreement, I believe, with Stripe to actually embed stablecoins in their offering. You can see how what can come next, right? And it's not only payments; it's also, for example, you can make payments instantaneous, so you can reduce the working capital of businesses. As we know, the businesses with a long supply chain, they have massive working capital needs. You can actually provide loans across the supply chain, a bit like what the buy now pay later companies in the past were promising. You can actually have way more sophisticated uses of money in your stack. And I think this is going to happen in the next years. I think the payments is the low hanging fruit, and then there is a big
Mm-hmm.
one, which is agentic commerce. When you have more agents actually buying and selling stuff, agents are not gonna call a bank for a loan or connect to an API that doesn't talk to the other API. These agents will most probably interact with a digitally native form of money, and I think blockchain is perfect for that.
Got it. So give me an estimate. Are you talking, are we talking 2 years? Are we talking 5 years?
Um,
10
I think 2 to 5 years.
ish? 2 to 5. Okay.
2 to 5. Yes.
Um, so if I'm a founder, especially working in the real economy, you mentioned something very interesting to me, which obviously working capital is a real thing, and most supply chains, there's choke points everywhere in our real economy, and so payment terms and all these other things are just brutal. This just brutal for small suppliers and smaller companies to work within. But so if I'm thinking about like controlling my own destiny, really having my own internal banking system for my company and my ecosystem, are there kind of two or three main things that I should be thinking about of like if stablecoin's a good fit for me, just generally speaking?
I think so. This will evolve uh, in tandem with operating systems also talking to this type of assets, right? We need operating systems that do like the supply management, etc., of goods, or also goods being represented. And this is not something I'm working on. It's a big problem surface. But even today, if you're a company that has a lot of international business and a huge, like a significant international payment flow, you should 100% look into stablecoins today, because the costs you save and the immediacy and the reduction of the counterparty risk you have is gigantic. So we all know, like, if there are business owners or managers that are sending wires around the world for goods, they know the pain, what it means to send uh, like $100,000 to Brazil, or even worse, if you need to pay a China supplier, right? So I'm not
Yep.
even gonna go into like more exotic situations. Through stable coins, it's just a matter of having like an intermediary that is doing the on and off ramping with the fiat locally, or even better, maybe you don't even need it and having a wallet account, and I'm gonna send you a stable coin into your digital wallet. You see it, and then you send me the goods. Most probably, you don't even
Yep.
want to have like the fiat cash again. So every builder that has a significant exposure to international payment flows should absolutely look at stablecoins today.
Great, super helpful. So give us just the current status of M0. Kind of how many people? I know you've raised some money. Kind of where are you guys at as an organization?
Yeah, M0 is a relatively young company. We started the company 2.5 years ago, but we started aggressively. We raised 2 rounds of funding, circa $60 million of funding from some of the most reputable investors in tech, including Bain Capital, Pantera, a few others, Galaxy, Parafy, World Capital, etc. Otherwise, my investors they get angry with me. But we have like a great cap table. We have a company, roughly 50 people, many engineers, growing every day, with like a strong New York presence, a strong Berlin presence. Who knows, we might go back announcing additional capital raises pretty soon. But I think we are really not in a building trajectory. The infrastructure that M0 has built is live. So currently there are already $350 million of M0 powered stablecoins that have been created and that exist in the system. You can see how people are using it on dashboard.m0.org. You can see what assets are backing them on a daily basis. Imagine having a bank account, imagine having a balance sheet statement every day, and you can see everything of it. And we are growing quite a lot.
All right, we're back. The sun's shining in my face, in my office. We're back from technical difficulties. Luca's hair is flowing, so we're going to wrap up here, the last segment. So, all right, Luca. So we cut the last segment cut off when you kind of explained why you're doing this work, like more at a personal level. A couple more questions on this. So, but why is it so important to you? This idea of like an alternative, decentralized financial system.
I don't know. I think there is a. I think it's not. I mean, it's not like a mission of sorts. It's just that first of all, I find this intellectually very, very stimulating. I think this is financial systems are social constructs. They permeate the entirety of our society, of our lives, and they're very symbolic in nature. I have a mathematical background. I love symbolic reasoning. So I find it an extremely fascinating topic, which and for some reason something that has been immune from innovation for a while, right? Like you have like the rest of the world has been advancing the last couple of decades, but the financial system has been quite medieval. So I think it's intellectual curiosity and intellectual desire and interest. I find it an extremely fascinating philosophical topic. And then I think everybody enjoys having impact. And I think this is one of the most impactful sector. I've always had a global life, and thinking that we can recreate a truly global and interconnected and fast financial system where it impacts everyone. I feel privileged doing something that I love, but that has such a broad impact. I think that is very different from having a startup, let's say, or a company that is trying to optimize a very narrow product or something that is very useful. So the horizontal nature of this effort fascinates me, and for me, it's a privilege, like to go around to build, to teach a university, to write stuff about stuff that I love and has an impact on so many other stuff of human life. It is a privilege, and that I enjoy.
Great. It's interesting. You mentioned this concept of horizontal technologies, or I guess I kind of, when I think about this, like also like systems level thinking, right? So when you're thinking about building new systems from an intellectual standpoint and also from a work standpoint, I always say this to people that when you're working, I think at the level that you're working on, and I think really what Going Direct is all about around this kind of more decentralized real economy, you're really thinking about it in systems, and that's actually much more of a creative pursuit, I found. So it almost, for me personally, my wife's always like, you're working all the time. I'm like, it's not work. It's kind of like my art and it's how I kind of get my creative side out, but most people don't think of that because you're an early stage startup or what it is, whatever it may be. But I tune it way more to art.
No, I truly agree. I think that, for example, in DeFi, decentralized finance, or crypto in general, we are in this phase of the industry where it's really creative. You think about systems. It's incredibly creative thinking, blank canvas type of redesign of systems, which I think is the coolest thing ever. I think in 10, 20 years, this sector is going to get very standardized, and the profiles of people working in the sector is going to be different. In the same way, the same thing happened to tech, right? If you see the
Sure.
profiles that were working in tech 30, 40 years ago, were anarchists, flamboyants, philosophers, very, very like outsiders type of people. And now it's very, very different, very, very different business. And so you actually encounter a lot of interesting people intellectually in crypto, in decentralized finance, distributed systems. You find a lot of scammers as well.
Sure.
They typically come combined, the intensity, the density of those folks, because it's not a standardized, it's not a institutionalized system. The same in finance. I think that people say, yeah, TradFi, traditional banking, investment banking. I'm pretty sure that if you go back 100 years at the beginning of the 20th century, and the JP Morgans and the bankers in New York back in the day were probably some of the intellectually most interesting people. Just like the world goes on, and the frontier moves. So working at the frontier, it's extremely exciting and stimulating.
Yeah, it's interesting. I haven't spoke much about it because it hasn't been very public, but I spent about a decade in the city. I'm from Detroit originally, so I got really involved in the city's kind of revitalization and a lot of community building, and ended up starting, of all things, a real estate development and investment company in commercial real estate in the city of Detroit when the city was going through bankruptcy. And I always use the term, and I've written a whole series of essays on this about how local real estate markets work. So, to your point around the actors that change as markets mature or stabilize or standardize. And I always tell people when they ask me, I said I was an accidental real estate developer because what I did had nothing to do with real estate. It was just the canvas that we used to create community and space for people to congregate and work and live at a time when the city needed it. So I can appreciate that. So M0's, as you mentioned, is really kind of attacking this at the infrastructure level to enable anyone to have their own stablecoin. How do you measure success for the project and what you're doing? Like, do you have a barometer here?
Yeah, for us is size,
Okay.
size of the network. Money is a scope economy product, meaning that the larger it is, the more value it has. So we're really trying to have as many projects as possible, controlling as much digital money as possible through M0 rails. So this is really not uncommon in crypto. So where people are quoting TVL, total value locked, as a measure of success, for us is also similar. So currently there are between 325 and $350 million existing in the digital life we live in that has been powered and secured by M0 rails. We would like to get this into the tens of billions or hundreds of billions over the next 5 to 10 years. And we want this to be, we are very agnostic of what those dollars power. Like, a banknotes are used by anyone from governments to NGOs to businesses to drug dealers. So I think that we're really agnostic on who is building, but at the same time we want to partner with projects that create very cool stuff for the users. So I think that for us, our two metrics is total size, total value locked. So the amount of float created by the infrastructure, and the number of extensions, we call them, the number of applications that are actually controlling their dollars through M0. These are the two things. So you will have noticed that unit economics is not one of those metrics. I think that for now, we are really not trying to maximize profit taking, because we are convinced that obviously if we create the global network of money in the future, there are so many ways we can capitalize on this as builders and our investors as well, in a fair way, right? Something that is hasn't seen as predatory as other solutions. But for us now is size. Size is our obsession. And we
Great.
have a lot to do.
So before we hop into kind of the rapid fire section, I did want to mention one thing. So we didn't have enough time today to speak about this, but I highly encourage everyone that's listening. Luca has it's pretty technical writing, but I think we didn't get into really dig into really your knowledge of financial markets and the traditional financial system. And kind of as preparing for this conversation, it really it impressed me. Some of the stuff I was a little bit over my head on the technical side on your Substack, but it's important for people to know that the amount of knowledge in your head and what you've written about and how the traditional system work and how you're applying that to creating an alternative one, it's shouldn't be overlooked. So I just wanted to make sure that was said.
Thanks.
All right. You ready? A little rapid fire.
Let's go.
What's something about the traditional or centralized banking system that you would like to see die?
Dumb compliance.
What's one myth about stable coins or crypto that drives you absolutely nuts?
That they're all the same, and they're not.
The most surprising thing you've learned since diving deep into creating an alternative to the traditional banking infrastructure?
That the regulator is not necessarily working to protect the consumers, but they're working to protect the status quo.
Can you give me one other name of a person in your work? It could be, or one other person. It could be personal or professional that's had a really big impact on you that other people should check out or know about.
That's a very difficult question. Let's go back to it at the end.
Okay.
I'll think about it.
And this one is important for me because if someone who's had not much knowledge about the stablecoin industry, is there a recommended resource that you go to or you would recommend for folks that aren't really knowledgeable about this that does a really good job at explaining this or to follow what's actually going on in the industry?
Yeah, this industry is difficult to follow because the traditional press is not the most sophisticated. So it moves on Twitter and Substacks. There are a few Substacks that I really value. I write, as you mentioned, but obviously my Substack is a bit more symbolic and detailed. I don't think it's necessarily too technical, but which is called Dirt Roads. Simon Taylor writes a great weekly Substack for uninitiated, let's say, like more product oriented. I don't remember exactly the name of the Substack. I think is FinTech Brain Food or something like that. But like Simon Taylor is a pretty renowned writer, so you can find it. Matt Levine writes his column, which is amazing, and often he touches on stablecoin. They write pretty high quality things. There are a lot of influencers or writers about newsletters about fintech that sometimes talk about stablecoins. I don't find them necessarily too illuminating. I think they are a bit too superficial. I think that what we're trying to do here is a bit deeper. But Simon and Matt Levine are my favorite writers. Very different style, but both very comprehensive. And Packy McCormick has been a friend of mine and great writer in innovation in general. He writes about crypto in a very extreme way, but like sometimes with good reasons. And he writes pretty cool stuff as well, with not boring.
Yeah, his stuff's great. Actually, he was one of the first guests on the show. So shout out to Packy. Who else should I have a conversation with at Going Direct?
I think you should have a conversation with. That is a good question. I think that in the stablecoin space, there are two people that I think are very smart. I'll give you three names. The first one works at M0, Joao Reginato. Joao is the chief strategy at M0, but he built USDC at Circle, and he ran USDC for 6-7 years. He is one of the best product people who has really lived through the history of stablecoins and crypto exchanges, etc. The other great person that you should talk to is Zach. Zach, who is the CEO of Bridge. Bridge got acquired by Stripe that operates in the stablecoin space. The guys are very smart. I respect them a lot. And the last person, I think on distributed systems and distributed financials is Will Scheinman, who is an investor of mine, researcher, very nerdy, but very knowledgeable about the new primitives of finance, etc. These are three people that I would definitely recommend talking
Okay,
to.
great.
Very different profiles.
Great. I'll be hitting you up. I'll be hitting you up to see if they're open for a conversation. How can people reach you?
So as traditionally, I'm on social media. I'm on LinkedIn. I rarely go on LinkedIn. I'm on Twitter. I'm quite active on Twitter with my name, my real name and surname. So it's at Luca Prosperi. I write a Substack, and if you reply to my Substack posts, this goes straight into my inbox, and I typically try to answer. And my email is very easy. It's luca@m0.xyz, 0 as a number.
Great.
And going back to like the people that influence me, I think that the two names that the three names I would give, very different, is Gödel. I'm a mathematician by background. Gödel was the mathematician who thought about the incompleteness theorem, and to me has been the best mathematician and the most influential mathematician in history. The beauty of it is that he wrote like probably 20 pages at 27, and this impacted the rest of the century. The other one is David Foster Wallace, one of my favorite writers, and I think that he pushes things at the limit, and I think it's good to remind ourselves that what we live is a social construct that we can obviously always reshape. And the third one is Jeff Bezos. I think Jeff Bezos is the best entrepreneur of our generation. So I try to read and study what he does. There is a beautiful podcast called Founders, and I'm not sure if you know. And the host goes through biographies and stories about founders of very impactful people over like a couple of hours per episode, and I find it great, very, very, very entertaining and enlightening.
Yeah, it's the thing about that stands out to me with Bezos that most people don't have an appreciation for, because they just look at like what Amazon is today, but the number of things that not only his ability from a capital allocation standpoint internally at the company, but how many things he invented and the team invented that just became like status quo, right? It's just like the one click shopping, and you can go on and on and on, and Prime, and you keep going. You can go a whole list of stuff, and everyone just takes it for granted as it always existed, and he invented all of this stuff. It's pretty mind boggling.
Yeah, and also the no bullshit, efficiency first type of approach in managing a business, which is very difficult because as the business scale, it's very difficult to keep that focus, and I really respect that.
Sure. Great. Well, hey, Luca, I appreciate it, my man. Thank you again for taking the time, and sorry for everyone out there for the technical difficulties.
My bad.
But, I will end with this one thing, which is I am definitely not betting against the piggies. So I'm with
Never bet against the piggies.
All right, Luca, I appreciate it, my man.
Thanks for having me. Bye. Sure.